Why do sensible and generally rational people sometimes make irrational decisions when it comes to investing? There is a truth in the old Wall Street adage, fear and greed rule the market. Emotions play an important role in investors' decisions. How can behavioral finance have any bearing on investor returns? Do supporters of behavioral finance believe in market efficiency? The objective of this video is to help students to understand how behavioral finance influences investment decisions. If there are a few basic mistakes that investors make repeatedly, it may be possible through education, training, and communication to reduce or eliminate these tendencies. This is an introductory video to behavioral finance. I hope this video can generate interest for students to explore how investor perceptions influence markets and how market action influences participants' perception. Let's start. Behavioral finance is commonly defined as the application of psychology to finance. This field of study considers how personal and social psychology influence financial decisions and the behavior of the financial markets. Behavioral finance includes the study of cognitive errors, emotions, and biases to understand how people make financial decisions. For years, economics and finance have assumed that human beings act in a totally rational fashion and therefore make cold and rational decisions about risk-return trade-off, about maximizing utility. However, psychologists have found that human beings do not behave as rationally as economists suppose. Conventional financial models based on rationality are convenient because then the theory reaches nice rational conclusions. But what happens when people don't behave rationally? This is the question that behavioral economics and behavioral finance are trying to answer. At its core, behavioral finance attempts to understand and explain actual investor and market behaviors, which is different from traditional and conventional finance. According to Mill's statement, standard finance people are modeled as rational, whereas behavioral finance people are modeled as normal. This means normal people may behave irrationally. The reality is, almost no one behaves perfectly rationally, and dealing with normal people is what behavioral finance is all about. Let's have a quick question. Fill in the blank. The answer is rational. Conventional financial theories presume that investors are rational. Behavioral finance presumes that they may not be rational. The efficient market hypothesis states that the market is informationally efficient if current asset prices fully and instantaneously reflect all available and relevant information. However, recent findings show that markets are inefficient. Inexplicable pattern of abnormal stock market return seems to contradict the efficient market hypothesis. In addition, market bubbles and subsequent crashes are good examples of market inefficiency. A joint test problem is a situation in which anomalies can indicate market inefficiency or market model inaccuracy. Why must prices depart from fundamental values? Some believe that the answer lies in behavioral finance. People are not 100% rational 100% of the time. Rationality means two things. First, when investors receive new information, they update their beliefs correctly. Second, given their beliefs, investors make choices that are normatively acceptable. If markets exhibit rationality, there could be no systematic differences between share price and the fair value of the security. The existence of excess return provides evidence against market rationality. For example, size effect, market-to-book effect, January effect, the day of the week effect are examples of market irrationalities. The mere presence of persistent anomaly calls into question market rationality. Why is behavioral finance important? Well, researchers in behavioral finance believe that investor decisions are affected by a number of psychological biases that lead investors to make systematic, predictable mistakes in certain decision-making situations. These mistakes, in turn, may lead to predictable patterns in asset prices that create opportunities for other investors to earn abnormally high profits without accepting abnormally high risks. Concepts from the field of psychology can be useful in describing the traps that often ensnare investors and can help investors make profitable investment decisions. There are two building blocks of behavioral finance. First, limits to arbitrage, and second, cognitive biases and heuristics. Heuristics are techniques for problem solving based on experiential learning. These are often referred to as rule of thumb. A heuristic often relies on discovery and is used to come to an optimal solution. One general heuristic for solving problems is to use common sense. Heuristics are non-reflective, intuitive mechanisms for coping with complexities. Arbitrage is an investment strategy that capitalizes on market inefficiency, buy low and sell high to generate superior return. Such strategies can be rewarding. However, have you ever wondered why don't overpriced stocks move down to fair value? One reason is that there are limits to arbitrage, that is, limits on the ability of the rational investor to exploit market inefficiency. The theory of limited arbitrage shows that if irrational traders cause deviation from fundamental value, rational traders will often be powerless to do anything about it. In reality, arbitrage is harder than it looks. When a mispricing occurs, strategies designed to correct it can be both risky and costly, thereby allowing the mispricing to survive. The costs and risks are fundamental risks, implementation costs, noise trader risks, as well as model risks. An underpriced stock may present a profit opportunity, but it is hardly risk-free because the presumed market underpricing can get worse. While price eventually should converge to fair value, this may not happen in near term. For example, the investor may be a mutual fund manager who may lose clients, not to mention about losing a job if short-term performance is poor, or a trader who may run out of capital if the market turns against her. A comment often attributed to economist John Maynard Keynes is that market can remain irrational longer than you can remain sovereign. The fundamental risks incurred in exploiting apparent profit opportunities presumably will limit the activity of traders. Transaction costs, such as commissions, bid-ask spreads, and price impact, can make it less attractive to exploit a mispricing. Short sale constraint is also an implementation cost. Short seller may have to return the borrowed security on little notice, rendering the horizon of the short sale uncertain. Some investors, such as pension or mutual fund managers, face strict limits on their discretion to short securities. This can limit the ability of arbitrage activity to force prices to fair value. Noise traders are non-professionals with no special information. When there is a shift in sentiment, these traders move together, which increases the prices and the volatility of this security during trading hours. Noise traders tend to follow newsletter writers, who in turn tend to follow the herd. These writers and the herd are almost always wrong, which contributes to excess volatility. Mispricing being exploited by the arbitrager worsens in the short run because of the noise trader. Noise trader risk matters because it can force arbitragers to liquidate their positions early, bringing them potentially steep losses. Arbitragers may worry that a mispricing, arbitrage, and profit opportunity is not real. They cannot be fully certain if a model to value the security is faulty or the market price is actually correct. Mispricing involves risks, which limit the extent arbitrage activity to be pursued. I hope you have learned something from this video. See you and goodbye.